Hi, my name is Brenda Simmons, and I'm with Presidio Real Estate.
And I'm Keith Payne with Superior Lending.
So in our previous videos, we have talked about all of the key players in your home buying team. So we've talked about you as the buyer, we've talked about the loan officer, the real estate agent, as well as the escrow officer. So today we want to talk a little bit more about how to prepare to be ready to look for a home. So not just looking for a home, how do you get ready for that stage? And there's really three things that we need to do to prepare. You want to tell us about those, Keith?
Thanks, Brenda. Yeah, there are three things that are the key elements to preparing to buy a home. Because preparing to buy a home does take time. It takes some planning and preparation to get ready. One of the first things is savings. So in purchasing most homes, unless you have cash on hand, you do need to come up with savings for a down payment. Mm-hmm. For a first-time home buyer on a conventional loan, that's typically 3%. Mm-hmm. You'll also need money for the closing costs as well. For a FHA loan, that's 3.5%, and most conventional loans are just 5% if you're not a first-time home buyer. If you have a USDA loan, meaning a home that you're purchasing in a rural area, or a VA loan because you're a veteran or have some military background or service, you may be able to do a zero down loan. So that's the first thing, is planning ahead and being disciplined enough to put money aside for savings.
Okay, but I've heard of zero down loans that aren't a VA or a USDA rural loans. Can you tell us a little bit about those?
Excellent. So yeah, if you don't have the capital and it seems unlikely you're going to get it, you can do loans where you have a first mortgage and second mortgage, where you're financing a large portion on the first and a second mortgage at a bit of a higher interest rate and 100% financing the loan that way. So that is an option. It's a little more expensive way to do it, but if you can't get in through a first-time home buyer or one of these other loan products, sometimes that may be the option.
Okay, so the key then is to really ask, right?
Correct. You need to understand where you're buying, what your eligibility is, and what might fit your specific situation.
Perfect. All right. So what other things do we need to do to prepare?
Excellent. So the second thing preparing would be your credit score. So your FICO score or credit score is a critical element in determining what your credit worthiness is. Lenders look at this score and determine, is this individual responsible about paying debts? Mm-hmm. So typically a 640 credit score is going to be the minimum to get into a loan. But if you can improve that score up to into the 700s or even 800s, not only will you be more likely to get the loan you want, but your costs will be lower, both on the terms of the interest rate you'll get, but also in terms of your mortgage insurance cost.
Interesting. So can a loan officer like yourself help somebody who has a lower FICO score improve that, and how do you do that?
Excellent, great question. And this happens quite often. People will come and say, I'm ready to buy a home, I'm tired of renting, or live in a mom and dad's basement, whatever it might be, and they're not quite ready, they're not quite prepared, but they're looking for that option or the steps they need to take. So we counsel them by indicating to them, here's where your credit is currently, here are the things showing on your credit. These few steps may help you to be prepared or to raise that credit score. If your credit is really low because of poor choices or poor situations you might have been placed in and you just have a bad score, you may talk to a credit repair company and have them help you to get your credit score up to where it needs to be eligible for a loan purchase.
And in that case, would you be able to refer them to a credit repair person?
Yes, okay. We work with a number of credit repair agencies that we refer individuals to help them in that process.
Fantastic. Okay, what's the last one?
And the third thing that you need to be worried about is your debt to income ratio. So this is called the DTI ratio, the debt to income. Lenders, again, are reticent to loan money to individuals who can't repay it, right? They don't want to put you in a situation where you're not going to be able to meet that loan obligation. So your debt relative to your income is what they're looking at. And debts would include student loans, any auto loans, any credit cards you have a balance on that you're paying monthly. So things like that are going to factor into your debt. And lenders are looking at that ratio to be at 43% or less, typically. Sometimes you can go a little higher, but you really want to be, they don't want you to have debts exceeding 43% of your income. So that's the target you're trying to get to. So eliminating your debts not only helps your FICO score, your credit score, but also gets your debt to income ratio at a point where you're going to be eligible for borrowing money.
Those are fantastic. And it's so fascinating how one thing affects the other, but really you have to look at all three points to get prepared to take out a loan. So thank you so much, Keith, for sharing that with us. I think the main thing to remember is to give yourself time. Actually looking for a home is really the third step in purchasing a home. And start with the loan officer. Then start early talking with your loan officer so that you know where you stand and where you need to go to be ready for that. So we hope that this has been helpful for you today. Next week, we're going to talk a little bit about how to get pre-approved, so you'll want to stay tuned for that. Until then, I'm Brenda Simmons with Presidio Real Estate.
And I'm Keith Payne with Superior Lending.
Take care.